Good morning, everybody, and welcome to our IFRS and corporate reporting webinar for June 2025. So, Kevin, it's the last one for this financial year, and we're looking at accounting for climate and other uncertainties in financial statements. So, as always, I'm joined by Kevin Frohbus. You would have seen last month I was missing in action. Kevin and Dean did the webinar. I attended our BDO Global Sustainability Conference in Paris, which was an amazing experience, and it was really good to hear what other countries are doing around sustainability reporting. But I'm back. Kevin, then I'm on the way again because I'm on my way to a bit of annual leave. So next month, Kevin and Dean will be doing the IFRS and corporate reporting webinar again. So thank you, Kevin, for doing that.
Hello, Aletta. Hello, everybody else. I'm going on leave too, but I'm coming back before you do so I can do the webinar.
So we've got it sorted in some way, Kevin. Now, BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. And we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. If you want to register for our IFRS and corporate reporting webinars, today, the red block, we're looking at accounting for climate and other uncertainties in financial statements. And then next month, Dean and Kevin will be looking at accounting for financial liabilities. And that's a real problem area, so please join that webinar. If you look at our sustainability webinars, next week I will be doing AASB S2 Pillar 3, where we look at streamlining climate risk policies. As you know, we've been stepping through AASB S2. We've already looked at Pillar 1 governance. We've already for 2 months discussed strategy. So this month we're moving on to Pillar 3, risk management. Please join me for that one. As you know, we are doing these quarterly carbon accounting masterclasses. We've just completed the June masterclass. Thank you for everybody that's attended. And we've scheduled 2 more. We've scheduled one for the 3rd of September and one the 3rd of December. And then I've received some feedback, and I feel a little bit silly that I didn't think about it myself. But I did receive some feedback that, Aletta, this is not a good time to schedule webinars the first week of the month. Accountants are very busy in the first week of the month. So apologies for that. For next calendar year, we will be scheduling carbon accounting masterclasses for the 2nd week of each month. And it will be scheduled in February, May, September, and November, so we avoid the holiday periods. But register for our September and December masterclasses. Then the big news today, earlier this morning, we've launched our AASB S2 climate-related disclosures checklist. So if you want to get ready for climate reporting with confidence, please look at our checklist. You can look at it. We've prepared it across the 4 pillars, and there's also some disclosures that we have to pick up from AASB S1. We've included that. There's 149 disclosure requirements in this checklist. It will help you to identify gaps and see how you are tracking to get ready for reporting. And shortly, we will also be launching our BDO template, AASB S2 mandatory sustainability report. So you can download the checklist at the bottom of the screen. So that's we're very excited to launch this checklist. Today's webinar is advertised as we are looking at accounting for climate and other uncertainties in financial statements. Now, BDO Global has a publication that was recently updated. It's a publication around accounting in times of uncertainty, because over the last number of years, we had a lot of uncertainty with the pandemic, with geopolitical issues, with the tariffs, So this is a nicely updated publication. I know Dean and Kevin discussed some of the aspects in last month's webinar, Getting Ready for 30 June 25 reporting, but I just wanted to flag with you this publication is absolutely relevant for the topic we're dealing with today. However, Kevin and I have decided to really pivot and focus on accounting for climate and the connectivity between financial statements and sustainability reports. And therefore, our starting point today is a focus on climate, but in particular, that interconnectivity. Now, interconnectivity, you would have seen the diagram on the right-hand side a few times, because a few years ago, the International Sustainability Standards Board and the International Accounting Standards Board published a joint article, and the link is there. The article was Connectivity, What is it and what does it deliver? And they talked about how the two boards, who are both part of the IFRS Foundation, how they are connected. And they are connected on the left-hand side. If you start at the bottom, they are connected around process. So they collaborate at a board and a staff level around process. Actually, Sue Lloyd, who is the deputy chair of the IASB, used to be a staff member at the International Accounting Standards Board, so there's connectivity already. So they connect at the board and the staff level from a process perspective. They are trying to then come up with products, meaning accounting standards, sustainability disclosure standards, that have the similar look and feel. So you've got the same implementation guidance, basis for conclusions, same website, and they try and connect the information. I think the big thing is we use the same concept of materiality in sustainability reporting as we have in financial reporting. So you can see on the left-hand side, they've got connectivity across process, products, and reports. And ultimately, they want to get to comprehensive general purpose reports. So on the right-hand side, you can see that the dark blue block is what the International Accounting Standards Board would do, financial statements. That is then, or we wrap around it, sustainability disclosures by the IASB. Together, that is what's going to investors. Is an absolute focus on primary users, investors and financiers. And the grey block are all the other disclosures and other frameworks, which are other topics that we haven't addressed yet, or non-financial disclosures. And that could be included in voluntary reports, for example. So connectivity, even at a standard setter level. Obviously, in Australia, the Australian Accounting Standards Board currently have the mandate to publish Australian accounting standards and Australian sustainability reporting standards. So it's even more connected within Australia. Kevin, if we look at mandatory reporting and that connectivity, our first section is around, before this mandatory climate reporting in Australia, what does the world look like? What does the connection look like? And remember, all of us are still in the before, because for 30 June 2025, nobody has to do mandatory climate reporting. So we are still in that before space. So Kevin, I'll hand over to you to step through what that means to us today and for 30 June 25 reporting.
Thanks, Aletta. And yeah, that's a good point. When we put this together, we actually thought, oh, look, let's go back. Let's go back to the summer of 2019, when climate change, actually, it wasn't the first time climate change came up in the context of IFRS accounting standards, but it certainly has been around a lot longer than the mandatory reporting that we now find embedded from 2025 onwards. So I thought I would return to this because it sets up the context about how climate should already be factored into financial reporting, so that you can, one, focus on it for the current year, but also you can start to see how it's going to link and interconnect or connect into the mandatory sustainability report going forward. It'll allow you to start to sort of take action and start to sort of see the bigger picture. So I kind of went back and I actually did a little bit of I went looking for some of the material that's out there, which has been around for some time. And back in 2019, at the international level and also in Australia, there was this document issued, which essentially talked about climate-related and other emerging risks, featuring in financial reports prepared under IFRS or AASB in Australia. What's interesting here is it's not just climate risk, it's other emerging risks, but the focus today is on climate, and that was a big part of what they were doing this. But I do want to kind of point that out. It's not just climate risks, although climate-related risks are one of the big emerging risks of our time. Of course, there would be others. So the concept is IFRS doesn't actually mention climate change, but the standard setters came out with this concept that climate change risks and other emerging risks are actually addressed. If you apply IFRS, you will actually address them in the standards. And they spoke about the concepts that risks and climate risks and other emerging risks, they're emerging, they're often not perceived to actually have an impact on financials, especially when they emerge over a long period of time. And also, there's this concept that what the organization says outside of the financials doesn't always make its way into the financials. So they talked about the connection of when would a risk actually become material for financial reporting purposes under IFRS, not considering mandatory reporting. I'm really just looking at the traditional financial reports prepared under IFRS. And they made the comment that there are qualitative external factors that often make a risk material. And at that point, it triggers something in the financials. And it's often disclosure, but at some point also gets integrated in the recognition and measurement of assets, liabilities, income, and expenses. And there's a nice little diagram on the right-hand side, which actually talks about how you consider assessing whether a risk becomes material based on qualitative external factors, which then would at least trigger a consideration on how to either present that, disclose that, or at least factor that into the assets and liabilities or an income and expense in the financials. And the first thing they put on there is sometimes there are investor expectations that actually could reasonably expect that a climate-related risk or some other emerging risk could have a significant impact on the entity. Notice that's on the entity, not on the financial statement. So there's a risk impacting the entity, and that risk could qualitatively influence investor decisions, regardless of the quantitative impact on financials. That's really important because everyone will tell you that if you read financial statements, it doesn't really say you've ever got to disclose risks, but risks that could reasonably impact the decision of an investor and that could have a significant impact on the entity, in other words, a business risk, and we mean opportunities here as well. They need to be then considered about whether they actually would have a material impact on financials. Once again, nothing here is new. I'm just covering old ground to make you aware of the fact that this exists out there in the market. And then you follow the decision tree after that, and you make an assessment. Well, could the risks affect the amounts that are recognized in the financials? If yes, determine relevant disclosures. And in other scenarios, if the risks and they could actually have a material impact on the entity's circumstances, you need to consider whether actually the amounts themselves would be impacted. So there's kind of a decision tree there. But it's putting out there the fact that risks that impact the entity or could significantly impact the entity may themselves be material in the preparation of the financials, and that may at a minimum be disclosure. So that's the concept. That's the base concept. I'm not going to get into it any more than that, other than to say the Australian, the ASX, for example, they've had this concept for a while in another form. It's called the OFR, where you've got to disclose the impact of risks on the business. It's another form of this, but it is essentially incorporated into this assessment in a way, because in Australia, if you're having to do an OFR and report on risks, it starts to have the same impact of this sort of assessment. Is they need to be disclosed. You need to consider the impact on the financials. Is there disclosure that's necessary? Even if that risk doesn't impact the numbers themselves in the current year, you should be disclosing the risk itself. Okay, so that's the theory. Let's jump to the next slide and kind of show you what this looks like in practice. Out of that came this concept of how you might reflect climate and other emerging risks in financials. This is almost kind of a laundry list of concepts, and I'll run through some of them. It's kind of a checklist of the areas where you would expect to see climate or other emerging risks triggering their materiality for inclusion, either through disclosure or impacting the numbers. And this has been revised over a number of times, but I'll just kind of point out a few ones. Things like disclosures about sources of estimation and judgments. So one of the requirements in IAS 1 or AASB 101 is to actually disclose whether, as a result of a risk, there could be a material adjustment to a carrying amount of an asset within the next financial year. I don't think it's known that disclosure exists, that requirement. It's often quite poorly done, but there actually are disclosure requirements already in the standard that says if you've got a significant risks, if it could impact or materially impact the carrying value of an asset or liability, in the next financial year, you've got to make some disclosures around that. That's a manifestation of this concept. But what they mean by significant risk is climate and other emerging risks. That's what they mean. They don't just mean the normal run-of-the-mill business risks. They mean these things that are emerging like climate. So it's not that there's actually anything new here. You do have to actually kind of consider it. The other thing is, for example, going concern. Going concern actually requires management to take into account all available information about the future. And notice I say all available information about the future. And this is kind of where the driver is coming from, because it's not just a narrow assessment of, oh, I'm going to consider these three things. There is so much information out there about climate and the impact of a change in the climate and a move in the climate economy that actually this should already be featuring in going concern assessments. Even if it doesn't change the conclusion or the actual numbers in the financials, it may at a minimum require disclosure. That's the concept we're talking about here. Other things on this list worth pointing out: useful lives on asset. Clearly, the useful lives on assets are starting to get shorter, especially where there's technological advancements. And when that technological advancement is because of things like the risk of climate change or the opportunities in the market because of a transition to climate economy, that's a climate risk or emerging risk that may require disclosure. Okay, so I won't kind of touch on anything else other than to kind of let you work through that in your own time. But you can see the concept that we should already be seeing more disclosure in financials on climate. This is already out there. So let's see how well we're doing. This is just a little bit of background. This is a study, I think it came out in March 2025. It's a collaborative study between the Australian Accounting Standards Board, Chartered Accountants Australia and New Zealand, and the universities of Melbourne and Queensland. So I want to kind of give credit to them. This publication is available on those respective websites and information boards. So I have pulled it on there, but it is a very good study of how well are we doing disclosing climate and other emerging risks in financials. So I'll whip through the findings just so you can get some context. More than a third of companies have flagged climate risk in their financials. Energy and utilities are the sectors with the greatest prevalence of this, which I guess would stand to reason. And you can see on some of the other ones that the number of companies disclosing climate risk has grown significantly in certain sectors like consumer staples, industrials, healthcare, and real estate. And I would imagine that makes sense. But really important for the purpose of this session is asset impairment, estimates, and useful lives are the areas that seem to be where it's most commonly flagged in disclosure. So we're starting to do well on this. I guess my question is, if you're not considering climate risk or even disclosing it in your financials, then you're not in the 1/3 of companies flagging it. And the question then is, have you failed to consider it? Or have you considered it, you've concluded it doesn't have an impact, and you've concluded it doesn't require disclosure or an amendment to the financials? And I would hazard a guess that probably it's not being considered. The key takeaway on this is emerging risks like climate should already be part of the consideration and already be part of your financial disclosure under certain scenarios. Running through this in terms of some of the other findings in the report, and I've highlighted some of them quickly, is that the nature of the effect of climate risks on financials is mostly disclosure at the moment. And then there's just some of the areas again where climate is actually being considered and having an impact on disclosures and the numbers themselves, mostly around impairment, useful lives, and it is starting to appear in the assessment of financial risks. So, for example, IFRS 7 disclosures for financial instruments and so forth. Of relevance to today's discussion is the New Zealand experience. So there is New Zealand is a little bit ahead, or they've got some of this already disclosed, where we've got disclosures, and we're starting to see cross-referencing happening between the climate statement, which is clearly what's going to happen when we do this properly. Jumping on to the next one, then some quick disclosures. This is just an example, and I haven't chosen this for any other reason than it was actually in the study report, which I've quoted in the previous slides. And basically, it was an example of a disclosure from L'Oreal, France, where they actually made a disclosure that they've actually considered climate change in consumer behavior within the data used in their impairment test, and it actually did not have a significant impact on the carrying value of the assets. Now, that is an application of the materiality concept, where they actually went through a process. They considered the risk. It's clearly climate or environmental. They integrated it into the data and the business plans, but they concluded it didn't have an impact on carrying value, but they still disclosed the risk. Why? Because it's important to investors in the context. And that was the first question at the beginning. Is this going to have a significant impact? Is this risk going to have a significant impact on the business or on the entity? And the answer to that is clearly yes. So my question is, where is it going to have an impact on the business? If it's not changing the carrying value of the assets now, where is it going to have a significant impact? And clearly it'll have an impact in the future. And now you can see where we're heading, because that future is going to start to emerge in your scenario analysis and all these things we're going to do for the climate statement. And then the disclosures will start to emerge in the climate statement about that. So that's just I'm starting to lay the groundwork for where we're heading with this one. There is an ED that was issued by the standard setter. This is the IFRS standard setter on proposed illustrative examples, which was basically giving examples of the application of these concepts that I've just been describing. I've actually copied here one on impairment of assets. It has not been issued as a final standard, and it's really just illustrative examples which would be kind of put into the IFRS standards. But I think there's already enough evidence in the market, and based on this presentation today, of how you would do this. Risks that are material to the investors or the business, and emerging risks and climate are part of that, could by themselves be material, even if they don't affect the numbers in the financials in the current year, and therefore require disclosure either that they had no impact or what the nature of the risk is. And is this new? No, it's not. This is already what we should be doing. Now, let's get to the juicy stuff. Aletta, we get to the introduction of mandatory climate reporting.
Thank you very much, Kevin. So I think, Kevin, the before and where we are at 30 June, everything is driven by existing IFRS accounting standards, existing ASIC guidance, existing ASX guidance, and our existing accounting standards are already saying, think about these things, because if it has an impact on the numbers, surely investors would want to know. Now we're going the next step, and we're saying now we've got mandatory climate reporting in Australia. And in Australia, as you know, and we've discussed many times, we have legislation, and this legislation, please remember, the legislation is an amendment legislation, and it amended the Corporations Act. So the Corporations Act now have embedded in it a requirement to prepare a mandatory sustainability report. And very important that that report has equal prominence and sits next to the financial report. So you have your financial report, next to it your sustainability report, both required by the Corporations Act and both requiring assurance to make sure we've got credible information. And then there's that need for connectivity. The reason they're sitting next to each other in the same annual report is we want connectivity, and it has to be aligned. We have reporting standards. So in Australia, the mandatory one, AASB 2, climate-related disclosures. And this is talking about all the things that have to go into that sustainability report. But now one would see, if I read this mandatory sustainability report, and if I read about certain climate risks, and if I read some of the information about anticipated financial effects, immediately as a reader, I would think, I wonder whether they've also picked it up in their financial statements, which is a few pages earlier in the report. So that connectivity is now easy and important. And then obviously we have the assurance standards. So the new composition of the annual report, you've got your annual financial report, the financial statements, you've got annual sustainability report, the mandatory sustainability report, you've got a director's report and an auditor's report. I've said earlier in the webinar, we've launched our AASB 2 checklist. This is an extract from the checklist where at a high level we provide an overview of all the things that will be disclosed in AASB 2. Pillar 1 around governance, and the details are in Table 1. There are 9 disclosure requirements. Pillar 2 strategy has the most disclosure requirements, 56 distinct disclosure requirements, and that's incorporated in Table 2. And then we've got a Pillar 3 around risk management and Pillar 4 around metrics and targets. So that would be your carbon footprint, your climate-related targets, your GHG targets. And then very important, there's a fifth area, and that is in the appendix to AASB 2. They include certain requirements from AASB 1, which is a voluntary standard, and to make it easy on which things from AASB 1 you have to pick up when you only comply with AASB 2, which is mandatory, they've put it in an appendix. So we've also included that in our checklist. So the key thing here is we're talking about climate-related disclosures, and it's absolutely driven by you have to identify your climate-related risks and opportunities. And if you've got these risks and opportunities that are expected to have a material impact on your numbers, then you have to start to do additional disclosures. And in our Sustainability Monthly webinars, we've talked about what all these risks and opportunities are. So, if you look at risks, obviously physical risks, easy to understand. If global warming is not contained and it goes to a very high global warming, there will be a lot of physical risks in particular. Transition risk is more as a result of policies. If governments across the world decide that they want to try and limit global warming to 1.5 degrees, they will need to issue a lot of new legislation and policies, and therefore businesses will have to transition to those policies and comply with those policies and laws, and therefore there's a lot of transition risk to that lower carbon economy. It could be changing market behavior or customer behavior. It could be reputation risk. But on the flip side of the coin, there's opportunities. If we're going to a transition to a low carbon economy, what are some of the opportunities? But even if we're not transitioning to a low carbon economy, but we're going to have all these physical risks, carbon economy, then there's opportunities for some businesses around energy efficiency, energy sources. So I think it's important that the whole AASB 2 is built upon a climate risk and opportunity assessment. The very first thing is, what are the climate risk and opportunities being faced by the business? And that will drive future disclosures, which is very nicely articulated in this diagram from the TCFD publication, the TCFD report. It's an old report, 2017, but it's still beautiful and fantastic. So we've got all these risks and opportunities that's expected to impact two things: your strategy and your risk management. So you look at risk and opportunities, and based on those risk and opportunities, Pillar 2 how does it impact your strategy? Pillar 3, how does it impact your risk management? So that flow through, very important. And then finally, and that's the connectivity now, how does this have a financial impact on your income statement, your cash flow statement, and your balance sheet? Now, something that I think is really important is when we talk financial impact, I think there's a bit of confusion because we have already financial statements for a reporting period. Let's say 30 June 2025. We have financial statements. It already has a lot of information on assets, liabilities, revenue, income. So what will be added in this mandatory sustainability report under AASB 2? I just want to make it very clear that we have to disclose the financial effects in mandatory sustainability reports. So the financial of climate risks and opportunities. And it really comes out in two different ways. The one is, I call it business as usual type disclosures, but it's in your mandatory sustainability report. Because I'm saying business as usual because you're looking at your existing strategy, your investment and disposal plans, your sources of funding. So, your current business as usual, you Hello, Kevin, can you hear me?
I can hear you now.
Okay, fantastic. Can you can you see my screen? I don't know what's
I,
happened.
you disappeared for a moment, and in the joys of live presentation,
I'll share it
you're
again,
back at
Kevin.
least.
I'll try. There we go. Okay, so Kevin, I'm back. You can
Fantastic.
see the screen.
All back.
I don't know what's happened, but here I am. So I'll pick it up on, there's two types of, or two places within the mandatory sustainability report that you will see disclosure of financial effects. There will be a lot of governance disclosures. There will be strategy disclosures. There will be risk management, metrics and targets, the 4 pillars. But where can you expect to see financial effects? The one is business as usual type disclosures. And to me, that is disclosures that captures existing business as usual strategy, investment, disposal, sources of funding. And they articulate it in two different ways in AASB 2. They say you have to disclose the financial effects experienced during the current reporting period. So there's a big similarity between I've already experienced losses, maybe a loss because there was a flood, right? That's a current reporting period loss as a result of climate. Surely that will also be reflected in your financial statements. So that will have to be, I would say, the same, and there's a connectivity there. The second part, as part of business as usual, is what is your anticipated financial effects of climate-related risk and opportunities based on your existing strategy, investment disposal plans, sources of funding. What are the anticipated effects on the short, medium, and long term? Now, again, these anticipated effects under a business as usual scenario, surely that would align with how you've done an impairment test for your business, how you've looked at asset values, how you've looked at going concern. So again, these business as usual disclosures have immense connectivity with financial statements. Then on the right-hand side, we've got the need, and it's mandated in paragraph 22 of AASB 2 that you are mandated to do a scenario analysis. And under the Corporations Act, you have to do at least 2 scenarios in Australia, one at 1.5 degrees compared to pre-industrial levels, and the other one well above 2 degrees, and that is where we're looking at least 2.5%. That's what's used in practice and in the profession. And then you can do other optional ones. AASB 2 don't mandate the 1.5 and the 2.5. That is in our Corporations Act. AASB says that you find appropriate scenarios. So, Kevin, I think the key point that I want to make here is we can expect disclosure of financial effects of climate-related risks and opportunities in the mandatory sustainability report in 2 distinct areas. One around business as usual, already experienced and anticipated, and the other one around scenario analysis. I think in discussions with clients, it became obvious that everybody was aware of the scenario analysis disclosure, but maybe the business as usual type disclosure has been somewhat overlooked. You can imagine there's a lot of connectivity here.
And I
I
think,
thought,
Aletta, yeah, just on that is kind of coming back to the beginning bits. The current disclosures under IFRS really only, if they are made, really only talk about business as usual, but business as usual and the impact on the current year results. What they don't contextualize is how business as usual starts to impact or translate into strategy, investing decisions, and so forth, which is going to start to feature in your mandatory
yeah,
sustainability report as a business as usual disclosure, and then also scenario analysis. So really, it's adding more context to what you might have already disclosed in your financials, but the financials really only talk about the risk and the impact on the numbers in the current year. What this starts to do is break that same risk out into strategy, investing, disposal plan, sources of funding over the report, over the current short-term, medium, and long term. So they're essentially they're expanding the disclosures in the
yeah.
financials, and then scenario analysis is further complementing that in terms of those scenarios.
Oh, absolutely, Kevin, and thank you for explaining it. I like the way you've articulated that. I thought before we make these big statements in our webinar, let's back it up with some extracts from AASB 2. So, paragraph 15 to 21 talks about the anticipated financial effects. And they say you have to look at financial position, financial performance, and cash flows. And I just want to show you by highlighting which parts, where did we get this from? Paragraph 15A is talking about current financial effects, which means your current reporting period. So it will also be in your financials, maybe expanding, as Kevin said. Paragraph 15B is saying anticipated financial effects. And you can see in that paragraph, anticipated financial effects, not just in the next financial year, but over the short, medium, and long term. Then in paragraph 16, they say an entity shall disclose quantitative and qualitative information. So the standard requirement is quantitative and qualitative information about these risks and opportunities and how they impact balance sheet, profit and loss, cash flow. And they say, in particular in paragraph 16B, they talk about the next annual reporting period. So paragraph 16A is the current period. 16B is the next annual period is specifically called out. And then in paragraph C, they say, and it's more than just the next annual period. It's actually short, medium, and long term. And I've underlined given its strategy, which to me means given business as usual strategy, and take into consideration investment, disposal, etc. That's where I got that from. And paragraph 16D is saying, okay, paragraph 16C is financial position. 16D is now profit and loss and cash flow. Again, short, medium, long term. Again, given your strategy. So business as usual, and they give some examples. So it's a further expansion on paragraph 15. Remember, they say in paragraph 16 quantitative and qualitative information, and then in paragraph 17 it doesn't have to be a single amount, it can be a range. And then in paragraph 18 they say an entity shall use all reasonable and supportable information that is available without undue cost or effort, and you have to use an approach that lines up with your skills, capabilities and resources. Now, I also want to warn you, paragraphs 19 and 20 says in certain situations you need not or you are not required to provide quantitative information. Please be very careful how you apply paragraphs 19 and 20. And I'll explain them step by step. Paragraph 19A, if you can't get the financial effects separately and you have to group it with others, that's okay. It's basically the concept of CGUs that we use in impairment testing anyway. So that's okay. In B, they say it should line up, and maybe you don't have to do quantitative disclosures if there's such measurement uncertainty, that the uncertainty is so high you don't have to do it. Please be careful. That would be used, I would say, extremely rarely in practice, because in financial reporting we are used to estimation. Whether it's financial instruments, derivatives, this is not an excuse. It should only be used in extremely rare circumstances. Basically, paragraph 19b, for all practical purposes, don't exist. Paragraph 20, I'll go that far. Paragraph 20, in addition, they say you don't have to provide these financials if you don't have the skills, capabilities, resources. Let's be very clear. If you're a Group 1 entity in Australia or a Group 2 entity in Australia, you have either the skills and capabilities in-house, or you've got the money based on your revenue and the fact that you meet Group 1 thresholds to buy those resources, get advisors. So paragraph 20, I just cannot see that even being considered for Group 1 and Group 2 entities. Maybe for Group 3. So be very careful before you. So when I close the door, I lose internet. When I open the door, my dogs bark. I don't know what to do anymore. So paragraph 19 and 20, be very careful before you hang your hat on them. And then even if you meet the criteria in paragraph 19 and 20, you still have to disclose information as required by paragraph 21. But just a word of caution, be very careful before you go there. So the disclosures that I've shown you, paragraphs 15 to 21, are all about the business as usual type disclosures, current period, next financial period, short, medium, long term. The other one that we flagged is climate resilience. That's paragraph 22, which says an entity shall use climate-related scenario analysis to assess their climate resilience. And this climate scenario analysis, we've got the 2 mandated scenarios in Australia, and then you can have more if you want. And then in green, you can providing quantitative information, the entity may disclose a single amount or range. So let's be very clear. Scenario analysis is mandated. There's a lot of disclosures in the rest of paragraph 22 of exactly what you have to disclose. And you have to provide quantitative information. And it can be a single amount or a range. It's not an option to just have qualitative information. Then we've also flagged that some of these disclosures, and we've highlighted them, it specifically talk about short, medium, long term. And then there's been a question, what does that mean? This is an extract again from the TCFD, the scenario analysis guide. Make it very clear that 2 things. You can come up with your short, medium, long term, you define it. Long term is open-ended. It's looking into the future forever and ever. So usually short term is your budget period, maybe the next year, 18 months, 2 years. Medium term is usually aligned with your strategic planning. Maybe the next 5 years, maybe the next 10 years, depending on your business, your industry. And then long term is obviously longer than your strategic thinking, so it's open-ended. So we just wanted to flag that as well. Kevin, I'll hand over to you to pick up some of the connected information.
Yeah, thanks, Aletta. So bringing it back together, and that was useful context. By the way, I feel like this might be the standard bearer presentation now on how this all comes together on the financials. I think it's really going to be useful. This I've picked up from an IASB presentation. I actually think it might have still been, or no, I think it was the IASB, and I've actually got a link up there for you. It is a good presentation to go look, and there's actually a webinar attached to it as well. So if you want more information, you can get it. But the key messages are brought together quite nicely in the visuals here, which is basically we now understand that for financial statement, which is historical information, we've already got to make some disclosures. And if risks are material, they might require disclosure. And that's not new, that's already bedded into financial statements. Going forward, we've got the mandatory sustainability reporting. And in our case, we have a climate statement. And what we have is a series of steps and processes towards building up climate risk and opportunity identification, which then leads to evaluating the impact of those risks on the business as usual part of the business, which drives information about the current and anticipated effects of climate. And then, of course, you've got scenario analysis testing that against the business strategy over 2 scenarios. Those disclosures essentially need to be identified and connected to the financial statements which you're already producing in some way or form. And then once you've made the connection, the disclosures in the mandatory sustainability will complement and expand on the ones that you've already done in the current financials, which is a lot of what Aletta has kind of been outlining. Some base enablers of that are the 2 financials or the 2 statements need to talk to each other. The financial statements deal with a reporting entity, a reporting period, reporting timing, and a presentation currency. And that must be the same as the reporting entity, period, timing, and presentation in the sustainability related report. And then when it comes to data and assumptions, they must be as consistent to the extent possible. Now, be careful of that. Ideally, they should be completely consistent and aligned, but there are some things in IFRS which make you make decisions in the accounting that don't necessarily align to business as usual strategy or longer term strategy. And a good example of that is when you do an impairment test, it makes you make certain assumptions about things like, do you include plans for restructuring in the impairment test? And that may not completely align with actual plans in your business as usual strategy over the long term or medium term on the sustainability side. So there will be sometimes at the data and assumption level, there might be a perceived inconsistency in the inputs on the financial statement versus sustainability. However, there are reasons for that. They are not trying to make the financials unusable. They're actually trying to make the financials understandable in the context. And then what you would do is explain the connection and the difference, and then break out your sustainability disclosures in your current and anticipated financial effects using the data assumptions that are appropriate on the sustainability side of the equation. So that's kind of the concept we're applying here. So you see there's a lot going on here. And also when you're preparing for sustainability reporting and the climate statements, you can't ignore the fact that your current financial reporting happens, and there's going to be a connection between the 2. Now, jumping on to the next slide now, we've actually covered this. It's actually outlined this quite nicely, this concept of the effect of sustainability-related risks and opportunities on the current position, performance, and cash flows, and then the anticipated. So I will jump over that to an example I kind of made before to show you this in practice. This is the L'Oreal example I had earlier in the presentation. And what I was trying to demonstrate is they've made a financial statement disclosure currently in their financials that the impact of climate change on consumer behavior, so transition risk, has been taken into account in the business plans for the impairment tests. It hasn't impacted the numbers, the carrying value of the assets in the current year, but they've made the disclosures to the investors in the financial statement. So that's on the left-hand side. When we add the mandatory sustainability reporting onto this and start to create connections, the way you would approach that is you would first say, first of all, has the sustainability related risk or opportunity affected the financial position, financial performance, or cash flow in the current year? The answer is, well, no, but they have made a disclosure on that. But then, what about the effects of that in terms of the long-term, short-term, medium-term, and the anticipated financial impacts into the future? And so that would then start to create the need for this complementary disclosure in the sustainability, because the nature of the driver on both sides of the equation here is what? A transition risk being consumer behavior. So there's your climate risk, which is coming forward in the sustainability report. This slide only deals with, you would have to make quantitative and qualitative current financial impact disclosures. On the next slide, then, you would also have to make the anticipated financial effects over the short, medium, and long term. And what you would have to do is then align those two on both sides. Just out of interest, if L'Oreal had not disclosed that they had taken the impact of consumer behavior into the impairment model in their current financials, it would still appear as a disclosure then in the sustainability report, because clearly it's an identified material risk which is having an impact. And then they would probably actually make that disclosure in the sustainability report. They would actually say, well, actually, it didn't have an impact on the current year, but here's the next annual and over the short term. So it's got to appear somewhere, and the two must complement each other. Once again, it's not it's not just because it's appearing in the mandatory sustainability report does not mean, oh, suddenly I actually need to go add it to the financial statements, although I suppose it could be an indicator that it surely needs to be considered, but it will certainly manifest in the mandatory sustainability report because you're adding all that context to that risk, which is clearly already identified by the business. And then the last one, and this is the last one, and we can then kind of wrap up. This is an example from the IASB's presentation, and I kind of liked it because it starts to show some of the context in play. This organization has identified a 5-year transition plan to electric vehicles. So this is a sustainability, a climate-related opportunity. It might be responding to a risk, but it's clearly an opportunity. It's obviously manifested enough so that it's identified for disclosure in the mandatory sustainability report. What is essentially required here? Well, you would then take that transition plan and understand whether it has a current year effect on the financial position. So that's your business as usual disclosure. And ideally, it would actually be in your financial statements already. You would make some disclosure to the investors in your financial statements that you've got this transition, might not have an impact on the current year, but it is a material opportunity that has been identified and it's been factored into the financial statements. But even if it wasn't actually in the financial statements, coming into the mandatory sustainability report, you have to kind of make the disclosure. It hasn't had an impact on the current year, but it does have an impact over the future years, the anticipated financial impacts. And notice what's happening here. Years 2 to 5, which probably would align to a short or medium time horizon as part of the strategic time horizon. And then the disclosures they would make would be the quantitative information regarding the capital expenditure required for new vehicles, which then have to use charging points, as well as what's going to happen on the reduction in fuel costs. So this is what Aletta talks about, your business as usual disclosures. But it's not just, oh, it didn't have an impact on my current year financials. What you're actually saying is my current year business as usual strategy is impacting my capital and my infrastructure investment that's going to happen. So I'm going to actually give you information about that quantitatively. And qualitatively, how is that going to impact my sources of funding in order to act the plan? So that has to be disclosed as well. So anticipated financial impact, even if it's a business as usual strategy, you're dealing with that in the context of how business as usual impacts investment and disposal plans, sources of funding. And so that's your bigger disclosures to complement the fact that in the current year it didn't have much of an impact on the financial statements. And then, of course, on top of that, scenario analysis is a separate beast. So that's it. That's bringing it all together. I think, Aletta, there's some examples which will let us wrap up from there.
Yeah, thank you very much, Kevin. Thank you for so nicely bringing the examples together. We've included some other examples, and we're not going to step through them. We've factored them into earlier, but the BDO UK has a beautiful publication written by Anthony Appleton, um, and he wrote an article talking about the impacts on financial statements. So it's currently in the pre-mandatory sustainability reporting. Where could we already consider and bring in these disclosures? And he's got a number of examples which I think is very relevant. And then I want to end with BDO Global has a publication outlining and discussing the proposed illustrative examples examples issued by the International Accounting Standards Board. So some commentary around those. It's not final yet, but I still think very relevant. So again, if you want to look at what you could do for 30 June 2025, there's the global publication, there's the BDO UK publication. Maybe some concluding remarks. I've got the first two and then Kevin's got two. First of all, very important that current and anticipated financial effects and those to disclosure requirements, the business as usual type disclosure requirements that are part of AASB 2, mandatory sustainability reporting, are designed to elicit information that connects, complements, and expands on information that is already provided in the related financial statements. And we are avoiding or trying to avoid unnecessary duplication. So it is complementing, expands, connects, connectivity. The second thing, we need a combination of qualitative and quantitative information mandatorily about these current and anticipated effects. Why? Because it's most useful for investors and financiers making investment decisions. Kevin, maybe the next two for you.
Yeah, the next two are really just to bring it back to your current year financials. So in anticipation of the mandatory regime that's coming, as Aletta said, for 30 June 25, no one's doing a mandatory report just yet. But bearing in mind, if you're identifying climate risks as part of your roadmap towards preparing for mandatory reporting, you may actually identify a risk that is already material for disclosure in your financials, because emerging risks might already have to go in there. So that's back to the first section of today's presentation. And then if you are identifying risks that are going to make it through to your mandatory sustainability reporting disclosure, which everyone will, there will be material climate risks and opportunities. Start to at least explore what you need to do to start the financials to talk to each other in terms of infrastructure. So making sure your accounting systems are starting to capture the information. So when you build the report later, you can start to link it to strategy, time horizon, and the interconnection will happen. Don't treat the preparation of the mandatory sustainability reporting in a vacuum from the financial statements you're already producing. They're clearly linked.
Kevin, thank you very much. So if you need assistance, I think it's a good time of year to just remind everybody that BDO has lease accounting offerings to help you with your lease accounting needs. We can also help you with IFRS advisory position papers. Our newsletter, Corporate Reporting Insights, will be published tomorrow for the month of June. Some great articles on getting ready for 30 June 2025 reporting ASIC focus areas. And then next week is our monthly sustainability newsletter. We have online education and e-learning that you can tap into. From an IFRS corporate reporting perspective, please reach out to Kevin or Dean or me, also Clark, Ashley or Lynn, so we can help you. From a sustainability perspective, if it's around carbon accounting, sustainability reporting, whether it's voluntary or mandatory, especially AASB 2, please reach out to Tom Hogben in Brisbane, myself in Melbourne, Ashley in Perth, and Kevin in Sydney. If you're more looking at strategic voluntary activities, our consulting team can assist you with that. And if you're looking for assurance, these are our key contacts across all the offices. I would like to thank all of you for attending this webinar. And I would like to acknowledge that Kevin has really helped me significantly to put all these slides together. I've been unwell yesterday and he stepped in very kindly and helped me. I really appreciate it, Kevin. And I didn't ask him, he just stepped in and did it. And that's what a good team player is. So thank you, Kevin. I hope all of you have a lovely day. Good luck for 30 June reporting. And remember to reach out if we can help you in any way.
Thank you, Aletta, and thank you, everybody. Goodbye.